Hello and welcome to Panther Financial Services. This is Prana Patil. Today we will discuss, is it possible guaranteed returns in the stock market? Now, we will try to understand this concept with the different products, pros and cons basically. And later on, you yourself will be able to judge, is it possible or not guaranteed returns in the market. Now, what is guaranteed returns or guarantee? Basically, guaranteed returns is nothing but you will not lose your principal amount. So, irrespective of the fact company goes up or goes down, or the company's profit goes up or goes down, or whatever thing happens in the economy, my money is safe and I will not lose a single rupee uh, of my principal amount. This is generally perceived as a guaranteed returns. Clear? Now, there are different products in the market. We will try to understand each product one by one. We will discuss five products and we will understand, is it possible the guaranteed returns or not. Now, first point is that the first secured product we perceive as a RBI bond or government securities or gilt funds. Now, understand, assume it that let's take an example of Sri Lanka. You know, uh, m- you're a citizen of Sri Lanka, and 10 years back, you invested or your fund invested a very big amount in the Sri Lankan treasury or in a Sri Lankan government's bond. What is the current scenario? Will you get your money back? There's a chaos in the Sri Lankan economy. Most of you know about it. But 10 years back, if you would have perceived, okay, it is a government bond, we will not lose the money. Government has given the securities. There is a central bank in the picture who has collected the entire money and they are monitoring the situation at the government, account level. But in today's scenario, you'll not be able to take your money back immediately. Of course, later on, after some time, once the situation is cleared, once the air is cleared, you will get your money back. But in current situation, you will not be able to get your money back immediately. So is it, what my point is that I'm trying to make you to think from a different perspective. Like if something happens, I just mentioned that central government securities, or we call it as a RBI bonds or this kind of securities. But if the situation goes wrong for a particular time frame, you will not able to get your money back. Even if the bond is secured or anything, that is we call it as a RBI securities or government securities are one of the secured product in the market. So think over it. If this kind of situation happens, what is the probability of this kind of situation? Point. This is the point number one. Now, let's take a second example. Second product is FD or corporate FDs or bank FDs or PSU banks bond, or this kind of bonds you will get in the market. Now, what happens? PSU banks are mostly backed by government. If something happens in the PSU banks, government comes in the picture with a bailout. They don't have any other option than the bailout, because they have earned a huge amount of dividends from these banks. It is not a free funding government does. They get a huge amount of dividend from a PSUs. So if something happens to a particular PSU, government, it is a responsibility of the government to come in the picture and to do a bailout. Now we have somewhere around 7 to 8 PSUs banks. So if something happens, what is the probability when you invest into say 7 banks? Each bank you invest, the PSU banks bond comes with a tick size of 10 lakh. So if we invest 7 banks with a similar tick size, what is the probability of 7 banks will lose the money or 7 banks goes the bankrupt? At if you invested in a one particular bank also, and if that bank goes bankrupt or that bank has a issue, what will happen? Just think yourself. The government comes in the picture. Now that time what happens? You need to have a patience. Now in the case of PMC bank, you most of you know what exactly happened. One of our most of our client have a money into PMC as well. One of our client mentioned that he is going to get that 10 lakh rupees after 10 years without any returns on that. but the what is the probability, he's an aged client, what is the probability of 10 years down the line he'll be there to take that money? Just imagine. So this is the point number 2. We will discuss my point is, what I'm trying to explain you, we will discuss at the end of the this five products. So first we will discuss what is the probability. Basically, first we discuss RBI bond or government securities or glitch fund, this kind of things. Second, we discuss PSU banks bond or corporate FDs, or PSU banks bond. These are the things. Now the third is equity. Now, in the equity, if you are unsecured about the particular company, if you invest into Nifty Bs or index Bs or index ETFs, what is the probability of it will go to zero? If all the 50 companies goes bankrupt, then it is a possibility of you will lose the money. Now, what is that probability? If that happens, then if those top 50 companies goes bankrupt, your money will not be safe in the banks also, because these top banks are part of index Nifty or Nifty 50 or Sensex. What I'm trying to convey is, if those, of course there is a probability, if something happens, big chaos happens or earthquake comes on, there is a chaos happens, there could be chances. Because as per SEBI rules, we cannot give you any kind of guarantee in the uh, in the stock market. It is a clear rule, you cannot give any kind of guarantee. So you must have the sentence that market investments are market to risk. What my point is that you have to, even in the case of bonds also, there is a rating comes, AAA rating, government NCDs, non-government NCDs, or AAA ratings, or redeemable securities. These are the things comes, or secured or unsecured. But point here is, you see the past situations like a S Bank, you see the ILFS case, you see the RCOM case. These were AAA rated bonds at the particular time. If there is a chaos happens, the agency, rating agency comes in the picture and they reduce the ratings. It's as simple as that, and you will not get even the idea when they reduce the rating or lowered the rating. When you got the security, that time there were like a AAA rating or a secured rating were there. But later on there was maybe there is a issue with the company and they change the ratings, and you are not having any idea about it. So there is a pros and cons, right, in this case as well. Now, third is the fourth one is futures. If you do a trade in the futures, what is the probability of losing money into futures? If you try to extend the exposure, if your limit or if your appetite is 1 lakh and you are trying to make a trade for a 2 lakh or 5 lakh or 10 lakh, then you will have a problem. Otherwise it is as simple as the equity. You wanted to buy say 1,000 shares in the equity, 1,000 shares of Axis Bank, you got into the futures, you have that much money, so indirectly you save that much money. So for example, if the Axis Bank shares is 500 rupees, you wanted to buy 1,000 quantity, the cost is somewhere around 5 lakh rupees. Now in the case of futures, same quantity you will get at 80,000 rupees. Remaining 4 lakh you save it, you don't need to invest. That is, when the MTMs comes in the picture, negative side, then it will require that amount of money. So this is the case of future. Now in the case of option, in the last couple of videos I mentioned that option trading is totally individual based. How you perceive, how you trade, individual account based. It cannot be replicate in all the accounts. So it is purely kind of like a self-employment or self-skill based this thing, option. And you cannot bet a big in the options, you cannot use a big amount in the options. Small quantum or small quantity of your portfolio you can utilize in the option. So option is not a part of this secured or unsecured things as well. So we discuss RBI bonds, we discuss corporate FDs or PSU banks bonds FDs, or then we discuss equity, then we discuss futures, then we discuss options. In the entire case, if you try to understand what my point is, that the security or the security, the guarantee goes in your mind. If you wear a black glasses, you will see a black. If you wear a white or red glasses, you will see a red. So my point is that if you constantly think on that, okay, what is the guarantee I may lose the money into this? Because the reason I chose this topic, because if I meet 100 clients, out of that 8 to 10 clients ask for a guaranteed return. The day before yesterday, I was meeting a very good client, and he said, okay, we are ready to put the XYZ crores amount, but the point is the guarantee. Will you give a guarantee? Point here is, we cannot give a, or nobody can give you guarantee in the market. The reason, because it is illegal. You yourself have to think, what is the probability of top 50 companies goes bankrupt? What is the probability of 50,000 crore market cap company goes bankrupt, or 1 lakh crore company goes bankrupt? If there is a issue in the company, or the something happens, it is you have to take action by quitting that. Or if you think that company is good, and because of sales or profits it's hammering, then you are open to hold that position. Hope you got my point. It is totally depend. So the answer to this question is, it's totally depend on you, how much you think on the guaranteed. My point is, if you have a food poison from a particular product, particular food, will you stop eating food? You take a precautious thing, you try to eat very hygienic food. So similar way, if you face, or if you had a very bad instance in the market, or particular securities or particular product, try to take a secured step. That doesn't mean that product is bad, or that product is absolutely not possible guaranteed return. Returns in the market is total depend on your mindset. Trust me, what kind of mindset you have. If you think the market is overvalued, it is going to crash, you are going to face that only. Now if you think that, okay, I am bullish on the particular economy, or particular country's economy, or India's economy, in the next 10 years, and okay, we I don't know much about the particular stocks, so I'll go for an index, ETFs, index more index, you call it as a bees. These are the product, if you select, or particular stocks also, you can secure your returns in that frame only. So in the market, guaranteed return, as per legal law, we cannot give you any kind of guarantee. But if you have a positive attitude towards it, and if you have a clear vision, or if you can see from your bullseye what could be economy, then you will have a guaranteed returns. Trust me, it is a fact. 10 years down the line, or 20 years back, if you look at the past performance and what could be the future, if you try to analyze, if you try to spend a good amount of time to understand how it works, you will find the stock market is such a big guaranteed place. Because it is, economy is going to grow only. And that is totally depend on your positive attitudes and the patience. Hope you enjoyed this entire discussion. If you have any queries, you can revert on the WhatsApp, or you can mention in the comment box as well. Thank you for your time. Have a great day.